Well, Mark, let's get your impression of Fed Chair Powell's news conference yesterday. Did anything in his words indicate to you that you should change your investment philosophy or buy something or sell anything?
Well, I think as the pivot to cutting rates and stopping the balance sheet runoff really means a lot in the credit markets. And when you think about the setup globally, where our central bank has been tightening and everybody else has been easing. And so I think this pivot really does kind of change your your mindset when you think about what am I doing with a market that we don't like. I mean, spreads are tight. They've gotten very tight. But the duration sort of aspect across credit will continue to be a very strong one. I mean, Carney said it this morning. I think everybody is looking at the fact that we've got $14 trillion of negative yielding debt across the globe, and it's growing. And I think the Bank of Japan leaked today that they're okay with their 10-year falling more. So
you're buying risk. So you're buying the riskiest credit.
I think what I'm doing is looking for more of this interest rate dynamic to be supportive of the markets in the near term. Now, in the long term, all this does is it continues to put pressure on this bubble that it continues to inflate across all of the globe in the credit markets. And at some point, right, when we need to start raising rates, et cetera, which is not now, obviously, that just makes it much more difficult. So right now, I'm actually strangely fairly positive across the credit markets. Equities, I'm a little bit more a little confused about where we're going from here. I think if we continue this negative rate dynamic and continue to cut rates in the U.S., it's very hard on our banks. We did a study where we looked at European financials versus European markets, and there's about a 50% difference between those stocks since they started NIRP. The same sort of negative dynamic happens with Japanese banks versus their index. So it's not good for your banks to have either a flat or negative curve or low rates in general. And it's going to be hard for the equity market to really kind of break out of this ceiling it's had at 3,000 without the financials participating.